Bitcoin has been lately looking to up its game by shifting its strategy to 60-40 rule. But the question is, will it benefit from this strategy? Welcome to our channel, Financial Insights, the place where you are always a little bit smarter and wiser after seeing one of our valuable videos so you can develop your financial knowledge. In today's video, we will be showing you Bitcoin ended investing and the new 60-40 rule. Don't forget to press the like button and subscribe to our channel so we can make even more financial content. Well now, without further ado, let's get straight into the topic. Okay, first off, before we begin to speak about anything, the 60-40 rule is a showstopper today. It is the strategy that involves constructing portfolios which are all allocated 60% to equities and 40% to bonds. The simplest implementation of the strategy would involve buying the S&P 500 and US Treasuries. If you were to go that route, your portfolio would primarily contain US investments. You could also build a globally diversified 60-40 portfolio by including international stocks and bonds as well. In theory, a 60-40 mix allows you to maintain balance in your portfolio when the market is high and when it is low. It's designed to minimize risk while generating a consistent rate of return over time, even during periods of volatility. In its simplest form, the 60-40 rule means having 60% of your portfolio invested in potentially higher risk, historically higher return assets such as stocks, and the other 40% invested in lower risk, but also traditionally lower return assets such as government bonds. The theory is that a 60-40 portfolio should provide equity-like returns while smoothing out the extreme highs and lows that come with an equity-only portfolio. The secret to making the 60-40 rule work. To make the strategy work, investors need to tweak their portfolio at least once a year to ensure it retains its roughly 60-40 split. This action is known in investment circles as rebalancing. In practical terms, it involves selling some outperforming assets and reinvesting the proceeds in their underperforming ones so that the mix of stocks and bonds remains 60-40. You need to do this because, for instance, if stocks have a good year and bonds have a bad one, equities could end up representing a far bigger percentage of your portfolio than 60%. Left alone, you could unwittingly end up with a portfolio heavily weighted towards one asset, and that leaves you exposed to greater risk. In this example, by selling outperforming stocks and buying underperforming bonds, the portfolio would again be balanced. In an ideal world, the underperforming assets would then begin to perform better, enhancing the total portfolio return, while also smoothing out volatility, that is, extreme highs and low price moves. All stock portfolios tend to have higher volatility than stocks and bonds together. Traditionally, investing in fixed income assets like US Treasuries offered the dual benefit of yield enhancement as well as diversification for those investing in multiple assets. The fixed, reliable yield of US Treasuries has averaged 4% over the past 3 decades, which has complemented the total return of multi-asset portfolios. In fact, 2.3% of the return from the above 60-40 multi-asset portfolio over the past 30 years has come from fixed income. This return carried little risk of capital loss, providing investors with exposure to some stability during periods of volatility in riskier portions of the portfolio. The historic hedging property of fixed income has helped make the 60-40 portfolio popular. While equities over the past 3 decades have returned 8.8% per year, volatility of the asset class has been high, 15%, with 3 periods of drawdowns where the market, as measured by the MSCI ACWI index, fell in excess of 30%. While a high-returning asset class, equities can also inject substantial risk into portfolios, and diversification across the asset class often fails when it is needed most. Bonds, however, have provided a ballast. Over the past 2 decades, the correlation between stocks and bonds largely has been negative, meaning when stocks have fallen, bonds have typically risen. This negative correlation, or dampening effect of bonds, has delivered volatility to the above multi-asset portfolio of 9.1% over the past 30 years, which is 5.9 percentage points lower than the all-stock portfolio. Does the 60-40 strategy still work? Over the last decade, a 60-40 portfolio could have returned 7.5% annually. However, record low interest rates and other policy initiatives employed by central banks to aid economic recovery after the financial crisis have distorted returns. The overall effect was a reduction in the return on government bonds. For instance, a bonds-only investment since 2008 would have just returned just 2.5%. This compares with the stocks-only portfolio that would have returned 10.3%. The low interest rate environment, combined with central bank monetary policy, has kept bond yields artificially low and pushed investors into riskier assets, such as stocks, in a search for higher returns. Traditional 60-40 portfolio with Bitcoin allocation. Bitcoin has an excellent price performance combined with high volatility. Rationally, these features would render it a perfect asset for diversification with more traditional investments. Let's explore how Bitcoin performs when included in a traditional 60-40 portfolio. 60% stocks, 40% bonds. When looking at 20-year annualized returns by asset class, 60-40 strategy has been a relatively stable option, offering 5.2% return annually. S&P 500 fared slightly better, offering 5.6%. While these returns well outpace the traditional investor, the real inflation-adjusted return for 60-40 is closer to 3.5% annum. We're also witnessing the longest bull market in history for stocks, so the long-term perspective might be biased. What would be the optimal allocation for Bitcoin in a traditional portfolio? By the estimation, the optimal portfolio would call for an allocation of 14-21% Bitcoin, 85-79%, 60-40. These weights would indicate an annual expected return of 13 to 23%, a standard deviation of 6 and 16%, and a Sharpe ratio of 166. This portfolio would obviously outperform the average annual returns of the 60-40 portfolio. The expected return of the model portfolio would also outperform the average annual returns of the S&P. Bitcoin hits fresh all-time high as big institutions look to join crypto party. Bitcoin, the biggest cryptocurrency, hit a fresh record high of $48,687.34 as some of the world's largest companies such as Twitter, BNY Mellon, and MasterCard have said they were looking to embrace cryptocurrencies. Twitter said it was considering paying its employees in Bitcoin, while major financial institutions, BNY Mellon and MasterCard, said they will enter the cryptocurrency business. The mayor of Miami, US, Francis Suarez, said he was mulling paying municipal workers and collecting taxes in Bitcoin. All developments come close on the heels of Tesla disclosing that it has invested $1.5 billion in Bitcoin. Moreover, BlackRock Inc., the world's biggest asset manager, said last month it will invest in the cryptocurrency. Bitcoin as an inflation hedge. Bitcoin is seen as an inflation hedge mainly because of its limited supply, which is not influenced by its price, and because of its relative attractiveness when real yields head to zero or lower. Yet, when you buy Bitcoin, you're not just doing so to hedge inflation. You're buying Bitcoin to hedge all the other negative consequences that usually accompany it. True, inflation is not always bad. Good inflation, a result of economic growth and low unemployment that helps to close the gap between supply and demand, encourages investment and even more economic growth. Bitcoin is also a hedge for unstable governments that close bank accounts, police states that want to seize private wealth, broken payments rails due to corrupted systems or outside cyber attack threats, paranoid leaders that want to disenfranchise opponents, export protecting devaluations that trigger more inflation. These are less likely in developed economies, but let's not forget that tipping points lurk around unexpected corners and that Venezuela was once one of the wealthiest countries in the world and one of the more stable democracies in Latin America. Bitcoin is a hedge against inflation, but also against political instability and social disruption, which, if inflation comes roaring back, it is not a ridiculous thing to prepare for. A dollar debasement hedge. Bitcoin is also a hedge against the more gentle but just as pernicious debasement of currency through a loss of trust. Traditionally, inflation moves in tandem with the strength of the local economy, but it can be triggered by currency weaknesses, which raises the prices of imported goods. This is usually corrected when the central bank raises interest rates to combat rising inflation, which increases the attractiveness of the currency compared to others. Bitcoin is a hedge for not just the macroeconomic ills that we have been trained to watch out for. It can also provide ballast against the unforeseen problems waiting to be triggered. The crazy thesis. This highlights another hidden strength of Bitcoin as an investment asset. In a world where you've gone from orthodox monetary policy to Keynesian economics to MMT in a few months, there is no longer any trust in the traditional recipes. To paraphrase G.K. Chesterton, when you stop believing in traditional recipes, your mind is more open to new ones. Bitcoin in portfolios represents more than a new recipe. It represents the need for a new recipe. It represents a hedge against crazy, which is hopefully not what awaits us. But the risk of not preparing for that possibility is verging on irresponsible, and not even thinking about it, it is likely to end up being prohibitively expensive. Given the above, the Bitcoin project looks like one whose prospects could seem inexhaustible, despite the impressive growth over the past 10 years. But make sure y'all go invest before it's too late. Type Bitcoin in the comments below after watching this video. Thank you for watching, follow us on Instagram, and make sure to subscribe and check out our other valuable videos. See you soon at Financial Insights.